Right, so liquidity. This is a huge topic and it's quite difficult to explain. I'm going to try my best, but it's something you're just going to have to practice and kind of see for yourself based off what I'm saying, based on what I'm telling you. It's just something you're just going to have to look for yourself. I'm going to try my best to simplify it and help you understand where liquidity sits, what it is, how to use it, all of that good stuff. So let's not waste any time. Liquidity is basically fuel for the market. So, price, the market has to collect orders in order to continue in a certain direction, which is why the market moves in waves. If the market moves up, why does it start slowing down and then start coming back down? Because it's running out of steam and it's running out of fuel. It needs fuel. So price then comes back down, collects fuel, and then can continue up. Price doesn't just keep going up. It typically doesn't do that because there's not enough liquidity. They need buyers to keep coming into the market to keep driving price up. But if price constantly keeps going up and we're coming to big highs, there's not going to be many buyers that want to buy at that price. Buyers want the price to come down at a discount and then they'll buy to then push price up. So that is basically liquidity. Price needs to come to an area where buyers and sellers are happy to buy and sell. So in a bearish market structure, price needs to come up to grab liquidity, grab orders for the sellers to be happy to then push price back down. And same for the buyers. When we're in a bullish market structure, price needs to come down in order to collect orders for buyers to be happy to buy at that level to then continue price up. So that's like a simple, very simple understanding of liquidity. It's just fuel that the market needs to continue in the direction it needs to, and that's why markets tend to move in waves. It just comes back down, grabs more fuel to then continue up, and vice versa. If price is consolidating, it is generating liquidity to grab, then move. It's generating liquidity to grab and then move. So what I mean by that, let me just show you a little drawing for an example. Maybe you've seen this if you are new to the market, maybe you haven't, but if you've been trading long enough, you've probably seen this where price is just consolidating, it's moving sideways, it's got no actual direction, and then price finally breaks down and then continues up and does something like this. So people who are trying to buy over here, they typically their stop losses get hit. So for example, let's say you see prices constantly going up, down from the same areas. So when it comes back down to these areas where you're seeing that it just keeps rejecting, you might buy, and price is going up and you're happy, but then price suddenly starts shooting down, hits your stop loss, and then finally moves up and then continues moving up. Maybe you've seen that. And the reason for that is as we are moving sideways, that is telling you that buyers and sellers are happy at that price. So they're basically competing with one another. The buyers and sellers are happy at this price, which is why we're not moving anywhere. There's not enough orders in the market trying to push price in a certain direction. So the only reason why price moves up is because there are more buyers than there are sellers. So more people are buying into this market than there are selling. So if price is moving sideways, that's simply telling you that it's pretty much even. The buyers are even to the sellers. So there's 10 buyers and 10 sellers, all with the same position sizes. So price is just moving sideways. It's not really going anywhere. But if a buyer wants to come in and he wants to actually buy a lot more, he might push price down, buy at a lower level, and then push price up. Now, who are these buyers that would do that? Institutions, hedge funds, these really big market makers. You have to understand how they enter the market. They have such big, huge position sizes. They would just want to inject so much money into the market. They can't just buy where price is. They need liquidity to be able to buy into the market. So they need people to be selling their positions so that they could buy. Now, I guess an easier way to understand this is that as price is going down, so let's say people are buying over here, right? They are buying over here, price is moving up, but then price starts moving down and it starts going into drawdown. So those buyers that are trying to buy over there are now panicking. They want to close their positions, they want to sell their positions, and as they're selling their positions, who's buying those positions that they're selling? Because for me to sell you something, the other person has to buy it. So as these buyers are trying to sell their positions now, that doesn't mean they are getting into short positions, not trying to now bet on the market going down. They are closing their positions, but they need someone to buy that off them so that their position can be closed. So as price comes down, those buyers are all selling their positions, giving that liquidity into the market, allowing these big buyers to finally buy into the market because there's not enough liquidity. So if a bank wants to buy right here where everyone's buying, there's not enough orders, there's not enough liquidity in the market for them to buy. So they have to push price down in order to buy the position that they want. So what banks and institutions might do is they'll inject a sell position, which will push price down. It will make all the buyers panic. Then those buyers will sell their positions, giving all of that liquidity to the market, and now the institutions can see that liquidity and buy into it, and finally their big orders can be filled, and that is what can push price up finally. So now they can get their actual big buys in the market. They can't just buy regularly, they have to get discounted prices where people are panicking and selling their positions, and that's where finally buyers can get in with the big institutions and hedge funds. So when you understand that concept, that price has to come lower to then go up and vice versa, then you can understand that when your stop losses hit, it's probably because someone else wants to get into a buy, but they can't really get filled into the market, so they need everyone to sell their positions, panic and get out, so then they can actually buy and move the market up. I'm sorry, this does sound quite complicated, but the more you see it, the more you understand it. Simply put, price has to come lower for big buyers to come into the market to buy and push price up. Same for selling. Price has to come up higher for sellers to be happy to sell and finally get enough orders and liquidity to finally sell the market, and then we can see a big price drop, which is why when we look at this example right here, we have price retracing down, then the buyers can come in to push price up. If price is already up at this high, you're not going to be seeing institutions and banks buying at those highs. They will bring price down. Now, whether they do that through selling, putting into short positions to push price down, making everyone panic, selling off their positions, giving that liquidity to the market, giving that fuel, everyone's dumping their fuel, and then the banks can come in and take that fuel for themselves and then put in their positions, then you see price finally moving up. So that's kind of how liquidity works. So when price is consolidating, moving sideways, simply put, buyers and sellers are happy over here, but there's not enough liquidity to actually push price anywhere. So like there's no buyers or sellers that are basically wanting to push price in a certain direction. And in order to do that, they need to make the other side panic. So when the other side panics and closes off their positions, then the real person can get in. So this is an example of what consolidation and a liquidity grab can look like. So this is what you call a liquidity grab. Basically, price moves down, people's stop losses are hit, grabbing liquidity. Now the institutions can come in and then price can move into the direction that it's intended to move in. Same over here. As price is moving up, anyone that's buying over here, as price is moving down, they're panicking, they're closing off their positions, they are selling their positions, and then finally that is enough liquidity, enough money in the pool for the buyers to come in, grab that money, and then fill in their orders. Their orders can finally be filled into the market, and then price can push up, and vice versa for when you're selling. So that's how liquidity works. Now, numerous types of liquidity. They can rest in areas, for example, highs and lows, so like we talked about over here. Inefficiencies, so fair value gaps. So basically, when fair value gaps are formed, that's basically an imbalance in the market. That is resting liquidity because there were orders over there that weren't filled. Basically, as fair value gaps are formed, price was impulsively moving in one direction, so the sellers actually couldn't get their orders filled into the buy. So let's say price is moving up very impulsively. At that point, there were probably other buyers who were trying to buy, but they couldn't. Price was just impulsively moving up and they couldn't get their orders filled. So price typically comes back down to that area to grab their orders finally and then push price up. So it's basically, that's kind of like how liquidity works. It needs people to be filled into the market, and that's how they're filled into the market, by price coming down or coming up into those areas. So now we just need to identify where are those areas sitting so that you can use it for your advantage. Session highs and lows. So basically the market has trading sessions. London session, Sydney session, New York. So it starts pretty much, the day starts with Asian session, then it moves on to London session, then it moves on to New York. These are the three major sessions. So basically, when Asian session is active, that means countries like Japan and China, those countries are, and Sydney, so Australia, those countries are actively trading the markets. And then when it comes to London session, then that means, of course, the European countries, so the UK, and other European countries, they are trading, and it's their morning, it's their trading session. And then New York session obviously is America coming into the market, which is around 1 o'clock UK time. So you can search about these trading sessions. It's nothing like special, but basically understand that there are different timings for different trading sessions, and it's Asian, London, then New York. I typically trade London session, and the reason for that I'll explain later on. So session highs and lows, that also acts as liquidity. Those are basically points where price is pulled towards. That's another thing you're going to be seeing me talk about a lot more, and that is the phrase draw on liquidity. So it's basically a magnet. Wherever the liquidity is sitting, that's where price is being pulled towards. And if you know where price is being pulled towards, you know where that draw on liquidity is, you can use that to your advantage. So we have news, highs and lows as well. So when news events come out, so let's say non-farm payrolls, as we spoke about, NFP, that is like a big major news event, major economic news event, and then price sometimes just wicks up and straight wicks down, or anything like that. It's just a huge move suddenly. And typically we can see that those big wicks that are created with that news event, price usually comes back up to those highs and lows that were created in that news event. Because as those wicks are created, there's a lot of orders that can't be filled. So buyers and sellers couldn't get in at that price because it was just too quick, and big orders couldn't be filled into the market. So price has to come back up to those areas, or down to those areas, so that those big institutions can get their positions filled into the market. So that's why we see price coming up and down into those news highs and lows. Don't worry, this is a lot of information. I'll be showing you more examples, and as we go throughout the course, you'll see me talk about it more, and then you'll see it in action, and then you'll probably understand it more. Cool. So, draws on liquidity. So how does that work? So when we're buying in a bullish market structure, let's just use this for example, when price is moving down, if we are in a bullish market structure, we are expecting price to come up to this high, because when price moves up and then comes down, making a higher low, we are then expecting another higher high. But that liquidity is sitting at the previous high that was created. So that is because obviously over here, when people are selling, that's people panicking. As price is coming up, people are trying to buy, but then price starts moving down. People are now scared, and now they're selling their positions. So we need to take these people out. Or, sorry, my bad. Or we could also see it as, when price is moving up, there are people trying to sell over here. So they are basically getting into their positions, selling over here, and as price comes down, These sellers are all happy that finally they're making money, but no, the big institutions finally get in at a discounted rate, and finally they buy, pushing price up, taking out these sellers. So wherever price is moving down, sellers are in the market. Wherever price is moving up, buyers are in the market. And it's a constant battle between them. So in a bullish market structure, these sellers, we are basically targeting them. Wherever those sellers came in, that's what you're targeting. And when price is moving down, as price is moving down, and then over here price finally starts moving up, these are buyers stepping into the market. So if we're in a bearish market structure, we're simply targeting those buyers that got into the market. So that's basically your target. So when it comes to actually trading liquidity and understanding where it lies, that is basically how you place your take profit and your stop loss, etc. So what I mean by that is, in this bullish market structure, as price is retracing, and let's say we get into a buy position over here, typically your first target is that previous high that was created. So if you get into the market over here, you're expecting price to come up to here minimum in a bullish market structure. So you can just place your TP with your take profit at the next high. And when you're selling in a bearish market structure, let's say you enter over here, and where would you be targeting next? You don't know how far price is going to move down. But in a bearish market structure, minimum you know most of the time you will at least minimum reach the next low, because this is where the sellers were trying to sell. This is where the buyers were coming into the market, trying to push price up in a bearish market structure. So then when you finally come into a premium area where actual big sellers are coming in, those sellers want to take out these buyers who think they're all funny. So price then pushes down minimum to this area where the buyers were coming into the market, and that's what you'd be targeting for your trade. So if you're selling in a bearish market structure, your take profit typically, to be safe, is at the next low, because you don't know how far price is going to go down after taking out this low. We might just come down here and then continue up. We might come down here, get a little retracement and continue down. But minimum, in a bearish market structure, for this next lower low to be made, it has to take out this previous low. So that's kind of where you place your TP. Same for when you're buying over here in a bullish market structure. Your target typically is the previous high. You typically wait for the previous high to be taken out, so that's what you target. So this is how you basically trade draws on liquidity. You have to understand where the liquidity is sitting, and then that's where you place your TPs, and that's basically what you're targeting. Now in this scenario over here, again, let's say we see price manipulate down, take out these stop losses, and then finally push up, breaking structure to the upside. Now we've broken structure to the upside, cool. We've created a market structure shift, right? Now that price is pushed up, let's just say this is a bullish market structure right here after we've broken this high. Price comes down, retraces, and then you take your buy. Let's say there's a fair value gap here below 50%. You take your buy. Your next target is simply the previous high. That's typically how you would trade it, because after the price moves up past this area, you don't know where that higher high is going to stop for price to then continue back down, to then continue back up, making the higher low. So if price breaks this high, creating a higher high, it's going to probably come back down to make a higher low and then continue up further. But you don't know where it's finally going to come back down from. It might just continue rocketing up, but minimum, it will come up to the previous high. So a way to trade markets with liquidity is simply targeting previous highs and lows. Whenever you're getting in on a retracement in a certain structure, so if in a bullish market structure, you're simply entering at a discounted level and your next target is the previous high. It's very basic. It's just a simple draw on liquidity, previous highs and lows in a structure. Same for in a bearish market structure. If you're coming up into a premium zone and now you're trying to take a sell after rejecting a fair value gap to the left, that's where you're entering in a premium area. In a bearish market structure, your next target is simply the previous low. because these are draws on liquidity. It pulls the market in that direction, and that's what you want to be targeting. So that's kind of how the basic draws on liquidity work. So let's just quickly recap so that we can get it all into one simple explanation. Liquidity acts as fuel. Big banks and institutions have such huge positions, they can't just buy at once at any random price. They need people to sell their positions in a large quantity so that the banks can finally buy them positions off them. So price, typically banks will push price down by injecting sell positions, make everyone panic. These buyers that were trying to hold their buy positions, they will close their positions. Now you have all of these sell contracts coming into the market, and someone has to buy that off them. And who buys that? The banks and the institutions. Those institutions finally can make that deal with that buyer and say, cool, you're selling your position in the buyer's selling in a loss, basically, and the institution's like, cool, we'll buy that position off you, no problem, at this rate we'll buy it off you. The buyer sells it in a loss, but the banks and institutions, they get it for a good discounted price, and then finally they can enter their big positions and price finally moves in the direction that they wanted it to. So again, liquidity is simply fuel for the market. Price has to retrace, price has to come into discounts and premium areas to grab liquidity and push price into the opposing liquidity, which is the previous highs and lows. So that's typically how the basics of liquidity works. There is so much to do when it comes to liquidity, and we'll get onto that in the future videos. Don't worry about it, but this is just a quick little introduction into what liquidity is. If you need to watch this video again, by all means do that, because I understand it can be quite tricky to understand. Hopefully I've done my best to help you understand just the basics of liquidity and what it looks like and how you can easily trade it or very simply trade it. So I'll see you in the next few videos, and we'll see how you get on with that liquidity.